Kai, rookie investor. Maya, senior investor. Nadia, financial journalist. Marcus, retired banker. 3 events Maya opens, 1 year. 0 decisions. Did you know your investment system kept running while your life fell apart? Job change in March, Kai admits. New baby in July. House move in September. He did not think about the portfolio once. He was too busy. He was too tired. He was also, it turns out, fine. The direct debit ran, Maya explains. The fund rebalanced. The ISA filled. He ran the annual review in January. Everything was exactly where he had designed it to be. The chaos was the test. The system passed it. Series 4 built the portfolio, Maya recalls. Series 5 tested it against real life, job change, baby, mortgage, couples, dormant pensions. Episode 29, the final test. 3 events in 18 months. The system that was built to survive exactly this. 6 episodes, Maya mentions. 6 life events, 1 system. Subscribe. The panel episode is coming and you will want to have seen all 6. Back to the question, did you know your investment system kept running while your life fell apart? Here's what the data says about the cost of intervening. Morningstar Mind the Gap 2225. Over the decade to December 2024, the average investor earned 1.2 percentage points per year less than their own funds. The gap is not caused by bad fund selection. It is caused by the timing of human decisions, buying late, selling early, switching during volatility. The investor who did nothing captured what the market produced. Morningstar publishes the Mind the Gap study every year, Nadia states. The 2025 edition covers the decade ended December 2024. Investors in funds with the most stable cash flows, those who traded least, lagged their fund's total returns by 0.8%. Investors in funds with the most volatile cash flows lagged by 1.8%. The more investors traded, the less their average pound made. Automation removes the decision at the exact moment when human decisions are most expensive. Source: Morningstar Mind the Gap, 2025. The portfolios that survived in 31 years were automated, Marcus confirms. The investor did not have a decision to make at the wrong moment. The portfolios that were damaged were manually managed. The investor had a decision to make and made the human one. Recessions, market crashes, job losses, the pattern is always the same. The system did not feel anything. That was the point. The question again, Maya reframes. Did you know your investment system kept running while your life fell apart? Here is the version that closes the series. The system was not designed to beat the market. It was designed to survive the investor. The chaos was not a threat to the system. The chaos was what the system was built for. One acknowledgement before the answer, Maya adds. This series was built for investors with consistent surplus to automate. If 3 life events in 18 months meant contributions paused, the annual review is still the right tool at whatever level you can sustain. The principle does not change. The amount is secondary. The automation at whatever level you can manage is the system. The automated investment system built in Series 2 is designed specifically to survive this combination. Maya states, it requires only 1 annual review, and that review is the only human decision the system demands. Everything else is handled by the direct debit and the fund. The chaos test is not an edge case. It is the whole point. The wrong belief, Nadia states, life events will always disrupt investing. There is no system robust enough to survive the combination of a job change, a new baby, and a house move simultaneously. Morningstar 2000-2005 confirms the opposite. Investors who maintained automated contributions through market volatility consistently outperformed those who made manual decisions. The belief that active management during chaos protects the portfolio is not only wrong, it is the mechanism that causes the damage. Source: Morningstar Mind the Gap, 2025. Investor return gap, 1.2 percentage points per year. Every life event is a commercial opportunity for financial services, Marcus states. The house move triggers mortgage reevaluation, life insurance review, conveyancing. The new baby triggers savings accounts, children's bonds, life insurance reviews. The job change triggers pension transfer services, financial planning reviews. None of these products are designed to protect the automated system already in place. They are designed to replace it with something the financial services industry charges for. The chaos is not a threat to the system. It is the opening. Job change, baby, house move, Kai admits, 3 events in 18 months. The portfolio kept running. The direct debit ran. The ISA filled. He ran the annual review. Everything was exactly where he had designed it to be. Maya delivers the statement. The automated investment system built in Series 2 is designed specifically to survive this combination, Maya states. It requires only 1 annual review, and that review is the only human decision the system demands. Everything else is handled by the direct debit and the fund. Set it, review annually. Never touch otherwise. This week, run your annual review. Check the direct debit is active. Confirm the amount still matches your plan. Confirm the fund is still running. That is the only decision the system requires. In the UK, ISA or workplace pension. In Canada, RRSP or TFSA. In Australia, Super confirm employer contributions are landing. In New Zealand, KiwiSaver confirm it is active. The account does not matter. The automation does. Job change, Kai confirms. Baby, house move, 3 events in 18 months. He opens the annual review. The portfolio kept running, the direct debit ran, the ISA filled. He expected damage, he found none. Everything was exactly where he had designed it to be. The 1% detail, Nadia states, Morningstar has published the Mind the Gap study every year since 2015. In every single edition, the gap has been positive. Investors have underperformed their own funds in every measured 10-year period without exception. The gap has never been zero. It has never been negative. The cost of human decisions is not a market phenomenon. It is a permanent feature of investor behavior. Automation removes the decision. That is the whole system. If Series 5 changed how you think about your portfolio, subscribe. The panel episode closes the series. Every character, one question. What survived? Subscribe so you never miss the next one. Next episode, marriage, kids, career change, 3 investors, 3 life events, the same system. Who survived financially, and what made the difference? The panel is coming, subscribe, and you will be notified the moment it drops. The episode that surprised the most people in this series is linked bottom left. Start there if you missed it.